Natural gas prices are lower to open the new trading week, likely due to the weather models showing cold failing to continue after the January 13 to 18 frosty shot. While the weekend weather data maintained a frosty cold shot into the U.S. from January 13 to 18, the weather models show temperatures rapidly moderating from January 19 to 22, with above-normal conditions spreading across the U.S. from west to east for easing demand. On a daily basis, total U.S. demand, including exports, would reach 158.2 billion cubic feet per day on January 16. That would be the most since Winter Storm Elliott in December 2022, but would fall short of the daily all-time high of 162.5 billion cubic feet per day on December 23, 2022. Similarly, in Europe, both Dutch and British gas prices are experiencing declines, driven by robust pipeline and liquefied natural gas supplies. The recent arrival of 3 LNG cargoes in Britain, along with high storage levels, is helping to offset the heightened demand caused by colder temperatures. Starting the season almost full at 90%, current stockpiles have only decreased to around 85%, allowing Europe to maintain a higher than expected level of gas reserves. If these current trends continue, Europe is set to enter spring, with more than half of its underground gas storage capacity is still available, compared to the 10-year average of just 35%. Still looking forward, extreme cold weather in mid to late January is expected to drive demand to its highest level since December 2022's winter storm record. This surge in demand, coupled with freezing conditions that could lead to production disruptions known as freeze-offs, may impact supply. However, at this point, it looks like the $3 level has offered a significant barrier. The current positioning of nat gas futures below the 150-day moving average of $2.85 is a bearish indicator. This break below the pivot, which acts as a critical level for both support and resistance, suggests that the market is experiencing downward pressure. Typically, when a market falls below a key pivot point, it indicates a shift in sentiment among traders, with more sellers entering the market, expecting further declines. Given these factors, traders might anticipate a continued downward trend in the short term. The next level of interest would be the main support at $2.70. If this level is breached, it could lead to an acceleration of the downward trend. Conversely, a recovery above the pivot point of $2.82 and the 150-day moving average might suggest a regaining of bullish momentum, although this seems less likely given the current market conditions. Thank you for watching. Please don't forget to support the channel if you enjoyed the video. See you in the next one.